Hello everyone. Now let's talk about the sales tax and trade discounts. These are all usually part of any kind of sales transaction. So we have to add the sales tax to any sales transaction, and of course sometimes we have trade discounts. So we'll see how we treat these in accounting. So sales of merchandise often involve sales tax, and the seller may offer buyers trade discounts. So almost all states collect a tax on sales of merchandise. The liability for the sales tax is incurred when the sale is made. So at the time of the cash sale, the seller collects the sales tax. When a sale is made on account, the seller charges the tax to the buyer by debiting accounts receivable. The seller credits the sales account for the amount of the sale and credit the tax to sales tax payable. So now we have a new account called sales tax payable, which is the amount that we collect on behalf of the state. So the main idea here is that we are going to collect it and then pay it back to the state. So let's see an example. The seller would record a sale of $100 on account subject to a tax of 6% as follows. So we debit accounts receivable, we credit sales, and we credit the liability account, which is sales tax payable. So you can see here the sales tax payable is 6%, and this is 6% of the $100, so it's $6. And then when we add the sales and the sales tax payable, the total accounts receivable to be that we expect to collect from the customer is 106. So we debit accounts receivable for the total value, including the tax, and then we credit our sales, which has a positive impact on stockholders' equity, and we also increase the liability, which is the sales tax payable, by the amount of the sales tax to be collected. On a regular basis, the seller pays the taxing authority or the state the amount of the sales tax collected. So at the end of, let's say, every quarter, we have to pay back the state all the sales tax that we collected. So the seller records such payment as follows. We have to reduce the liability, and we also have to pay cash, which would reduce our cash balance. So by reducing the tax liability or the sales tax payable, we're going to debit sales tax payable. Remember, tax payable is a liability. If we want to decrease it, it goes on the debit side. So we record it for $2,900. The $2,900 here is a number of all the sales tax collected during the month, or maybe a quarter, which is 3 months. And then we credit cash for the $2,900. So now you can see here, cash is going down, and also the liability is going down. So for trade discounts, it's slightly different. So wholesale businesses are companies that sell merchandise to other businesses rather than to the public, which again we call it business-to-business transactions. Wholesalers may offer special discounts off list prices to government agencies or businesses that order large quantities. We call these trade discounts. Sellers and buyers do not normally record the list price of merchandise and trade discounts in their accounts. So we usually just record it directly based on the agreed price. So the following adjusting entries for a retail business differ from those of a service business. One of those things that we're going to be talking about now is inventory shortage or shrinkage, and other thing is customer returns and allowances. So again, just going back to the trade discount, in accounting we don't really pay too much attention to that. We just need to know the name, the trade discount, and when we record a transaction, we record it based on the agreed price. We don't take into consideration any of the trade discounts. So let's talk about inventory shrinkage. And under the perpetual inventory system, the inventory account is continually updated for purchases and sales transactions, as we discussed that before. So every purchase transaction, we update the inventory, and of course after every sales transaction we record 2 journal entries, one to record the sales and the other one to record the cost of goods sold, which would have an impact on reducing the inventory balance. As a result, the balance of the inventory account is the amount of merchandise available for sale at the point in time. So that's the good thing about the perpetual system. We have an updated balance of inventory every single day, like based on the purchases and the sales that we made. However, retailers normally experience some loss of inventory due to some other factors like shoplifting, employee theft, sometimes errors, damage, as I mentioned before. So in this case, the physical inventory on hand at the end of the accounting period is usually less than the balance of inventory. We call that inventory shrinkage, and as I like to call it also, inventory shortage. So let's see an example. Net Solutions inventory on December 31st, year 8 is as follows. They have an account balance of inventory of $63,950, which is what they have in the book. When they did a physical count, which is basically counting the inventory value in their warehouse, was slightly less. It was $62,150. So there's an inventory shortage or shrinkage of about $1,800. How are we going to treat this? We treat it as if it's a cost of goods sold, and we reduce the inventory. So we're going to debit cost of goods sold, we're going to debit the cost of goods sold, and we credit the inventory for the amount of the shrinkage. Is it possible that we have an increase in the value of inventory? I doubt it. In most cases, there's always shrinkage. There's no inflation in the inventory, in other words. So typically, under the perpetual system, there is, as we said, like something would get broken, damaged, stolen. So that's why we have to deal with this shrinkage. So after the preceding entry is recorded, the balance of inventory agrees with the physical inventory in hand at the end of the period. And that's a good thing about this accounting treatment, is that we get to adjust what we have in the books to what we have in reality. And this is something that needs to be done at least once a year. So even if you are using the perpetual system, you still have to do a physical count to keep track of your inventory. So since inventory shrinkage cannot be totally eliminated, it's considered a normal cost of operations. There's no way we can prevent it. Like, things happen during the year. So unless you have a very, very secure kind of control, but still, things would happen. So the amount of shrinkage is unusually large. It may be disclosed separately on the income statement. In such cases, the shrinkage may be recorded in a separate account, such as loss from inventory shrinkage. Now let's talk about customer returns, refunds, and allowances. Sellers are required to estimate customer returns, refunds, and allowances at the end of the accounting period. Based upon these estimates, 2 adjusting journal entries are recorded. The first one is an adjusting entry that debits sales and credits customers' refunds payable for estimated customer refunds and allowances. And the second one, adjusting entry, it debits estimated return inventory and credit cost of goods sold for merchandise that is expected to be returned. So assume the following unadjusted balances for Net Solutions. We have sales of $715,409. They have cost of goods sold, which is usually less than the sales, for $523,505. We have estimated returns inventory of $300. We have customer refunds payable of $800, which is a liability. We have estimated cost of merchandise returned for year 8 sales of $5,000, an estimated percentage of refunds of year 8 sales of 1%. So let's see how we're going to treat these in the journal entry. So on December 31st, year 8, Net Solutions would record the following 2 adjusting entries. And I'm sorry, I said adjusting, like journal entry. These are adjusting entries. So they are done at the end of the year, on December 31st, as you see here. And they include an income statement account and a balance sheet account. So the first one is we take the 1% multiplied by the amount of the sales that the company made, which is $715,409. If we go to the previous slide, that was the amount of our sales. So the $715,409. So we take the 1% multiplied by that, and we are going to debit sales and credit customer refunds payable. So we assume that these are the amount of sales that are going to be returned. So we reduce the sales. When we debit the sales, we're reducing it. And we create this customer refunds payable, which is a liability account on the credit side. So we are increasing it. Then we have the estimated returns inventory of $5,000. That's debited, and we credit the cost of goods sold. So that way we also reduce the amount of cost of goods sold related to these expected returns. So the adjusted trial balance in this case would include all the assets, liabilities, equity, and revenues and expense accounts, as we've seen in chapter 3 and 4. So this is not new. The only new things is that we have added new accounts like estimated return inventory, we have customer refund payable, estimated coupons payable, we have cost of goods sold, and of course I forgot the most important one, inventory. This is a new account that has been added to the adjusted trial balance in this case. Now let's talk about financial statements and closing entries for a retail business. It's not much different from what we've seen before. So although merchandising transactions affect the balance sheet in reporting inventory, they primarily affect the income statement. So an income statement for a retail business is normally prepared using either a multiple step or single step format. So this is the new thing that we're going to see. We are going to get exposed to something called the multiple step income statement. What we've seen before was the single step, where things were very simple. We just list the revenues, list the expenses, and that's it. Now we're going to see the multiple step. It has like different stages that we have to follow. So here's an example of an income statement that's prepared based on the multiple step format. So we start with sales, which is the sales revenue, 708 in this case, and then we deduct the cost of goods sold, and then that's why it's between parentheses, to get the first important value, which is the gross profit. Okay, and you can see here it's divided into 3 columns because the very right column is the column where we have the final totals. But 187,950 is an important number, gross profit. That's the profit we made by just comparing sales to the cost of goods sold. Okay, and that does not include any of the operating expenses. The next stage, we want to calculate our operating expenses. And our operating expenses are divided into 2 types of expenses. We have the selling expenses, and we have something called administrative expenses. So selling expenses, these are the expenses that are related to selling a product or delivering the product and everything that's related to sales. Administrative expenses, these are expenses that has nothing to do with marketing or promoting the product. It's more administrative, it's things related to the office. So we want to get each category separate, and that's why we find here under selling expenses, we have sales, salaries expense, advertising expense, depreciation expense for the store equipment, we have delivery expenses, and we have other miscellaneous selling expenses. And then we get the total selling expenses. And then for administrative expenses, we have things like office salaries, and you see here these are more administrative, they have nothing to do with the product. The rent expense, we have depreciation expense for the office equipment, not the store equipment. We have insurance expense, we have office supplies expense, we have miscellaneous administrative expenses. And then we add them up and we get the total administrative expenses. We add these 2 totals, the 70,820 and the 34,890, to get the total operating expenses. And we put them between parentheses because these are going to be deducted or subtracted from the gross profit. Once we subtract the total operating expenses from the gross profit, we get a number called operating income. The operating income is 82,240. That's the income before calculating any other revenues or expenses that are not related to the main operations of the business. So operating income is the income that's only related to the operations of the business. Then if we have any other revenue, like rent revenue, that's not really related to the operation of the company. They have a warehouse or land that they're renting out. And then they have interest expense. Again, that's not directly related to the operations of the business. So we add the rent revenue, subtract the interest expense to get the total other revenues and expenses, and it turned out to be a negative value, so we subtracted from the operating income to get what we call it net income. Net income is the bottom line number in the multiple step income statement. So a few steps we have to be aware of. First, we need to get the gross profit, we need to get the operating income, and then we need to get the net income. So remember these steps. And to get the operating income, we have to calculate the total operating expenses. And to get the net income, we have to calculate other revenues and expenses, which is this value. Okay, so it's very important that we practice how to set up the income statement. I'm sure the homework is going to help you with that. So now let's talk about sales, cost of goods sold, and gross profit. Sales to customers for cash and on account are reported in the sales section. Cost of goods sold are reported next and may also be reported as a cost of merchandise sold or cost of sales. The excess of sales over cost of goods sold is gross profit. So this is the top part of the income statement here. Sales minus cost of goods sold to get the gross profit. Then we have the operating income. Okay, operating income, sometimes called income from operations, tomato, is determined by subtracting operating expenses from gross profit. Operating expenses are normally classified as either selling expenses or administrative expenses. So we have to have these two categories. So we have the selling expenses. These are incurred directly in the selling of the merchandise. Administrative expenses, sometimes called general expenses, are incurred in the administration or general operations of the business. Each selling and administrative expense may be reported separately. So for operating income, many companies report selling, administrative, and operating expenses as a single line item shown as follows. So we have these two values added together and then subtract the total operating expenses to get the operating income as follows. Then the last part is the other revenue and expense, and these are other revenues and expense items not related to the primary operations of the business. So other revenues could be from sources other than operating activity of the business, and the same thing for expense that cannot be traced directly to the normal operations of the business. These other revenues and other expenses are offset against each other on the income statement. If the total of the other revenue exceeds the total of other expenses, the difference is added to operating income. If reverse is true, the difference is subtracted from operating income, which was our case in the example that we had. So here we had rent revenue to be smaller than interest expense, so we ended up subtracting their net value. If rent revenue was more than interest expense, we will end up adding the total other revenues and expenses to operating income. And that's how we got the net income. The single step income statement is much simpler than that. The only problem with it doesn't provide enough information if you want to get more information. So basically we sum all the revenues, we sum all the expenses, compare these two numbers or get the difference to get the net income. The bottom line net income has to be the same. It won't be different. So if we look at this number and we compare it to what we had here, it's the same number. It's just how we presented the information is what makes the difference. And then we have the statement of stockholders' equity. We have the column for common stock, column for retained earnings, and then total column. And then we have the beginning balances, any common stock issued during the period. The net income would be part of the retained earnings because it's going to be added to the retained earnings. Dividends is something that would be subtracted from the retained earnings balance to get the new balances. So now we have common stock of 30,000, we have retained earnings of 186,200, and the total for that is $216,200. Then we have the balance sheet, which is again what we've seen before, where we have assets divided into current assets and property, plant, and equipment to get the total assets. And then we have the liabilities also divided into current liabilities and long-term liabilities. And the key thing here between current liabilities and long-term liabilities, these are, for the long-term liabilities, these are obligations that have to be fulfilled in a period more than a year, longer than a year. If it's less than a year, then it would be under current liabilities. And then the stockholders' equity section that also include common stock and retained earnings. We add up the total liabilities and the total stockholders' equity to get the total liabilities and stockholders' equity value here, $266,560. If I go back, this should match the total assets. And that's how the balance sheet would look like. And then the last process is the closing process. Again, not much different from what we've seen before. We go through the exact same steps that we've done before in chapter 3 and 4. So the closing entries for a retail business are similar to those of a service business. The two closing entries for a retail business are as follows. With closing entry 1, we debit each revenue account for its balance, credit each expense account for its balance, and credit the retained earnings account for the net income. So we debit the retained earnings account for a net loss. Cost of goods sold is a temporary account and it's closed like an expense account. So remember that we have to zero the cost of goods sold. So cost of goods sold, and it's an expense. It's usually recorded on the debit. in order to get rid of it or to close it, we are going to credit it. And then the second journal entry, or the closing entry, is we debit the retained earnings account for the balance of the dividends account and credit the dividends account. And this is how the journal entry or the closing entries would look like. So you see here we have the sales, rent, revenue. These are on the debit side. Normally they're on the credit. We're closing them. We put them on the debit. And then we list all the expenses on the credit side, because normally they're on the debit. We want to close them. We put them on the credit side. And then the difference is going to be recorded to retained earnings. And usually the difference is the amount of the net income. And then we close dividends. Remember, dividends that start with the letter D, they're usually debit, but when we close them on the credit side. And we debit retained earnings for the amount of dividends declared during the period. So after the closing entries are posted to the accounts, a post-closing trial balance has to be prepared. The only accounts that appear on the post-closing trial balance are the assets, contra assets, liabilities, and stockholders' equity accounts with their balances. So these are the same accounts that appear on the end of period balance sheet. These are the accounts that we call them permanent accounts. So if the two totals of the trial balance columns are not equal, we have an error and we must find this error. So this is how the post-closing trial balance would look like. And notice it doesn't have any dividends, it doesn't have any revenues or expense accounts. Now it's just purely assets, liabilities, and equity, which are the permanent real accounts. The last part of this chapter, we want to do some analysis. And the analysis for today is something called the asset turnover ratio. Very simple ratio, but it's very useful because it gives us an idea about how much sales were generated using our total assets. So the asset turnover ratio measures how effectively a business is using its assets to generate sales. A high ratio indicates an effective use of assets. The asset turnover ratio is computed as follows. We get the sales from the income statement and we divide it by average total assets. And how we get the average total assets? It's actually total assets for the last year plus the average total plus the total assets for the current year divided by 2. So the denominator is the average of the total assets at the beginning and the end of the year. And beginning is usually the end of last year. So let's see an example. So the following data were taken from a recent annual report. So we have total sales of 22,246 and total sales for year 2, 22,823. We're going to use the most recent sales, but for the total assets we're going to use the beginning of year 2 plus end of year 2 divided by 2. And notice that beginning of year 2 is the same as end of year 1. Okay, so when it comes to total assets, ending balance should be the same as beginning balance. So to calculate the asset turnover ratio, we get the sales divided by average assets, and we do the math here. You can see that for year 1 it was 1.39, for year 2 it was 1.53. So you see that the company is going to be more effective and efficient in their use of their total assets in year 2 compared to year 1. So for every dollar of invested in total assets, there are $1.53 generated in sales, which I think is very good. So by this I conclude chapter 5. Thank you for watching and listening, and wishing you all the best.